Hello everybody. Today we will talk about the relationship between different financial statements of the business. Financial statement reflects the effect on business transactions and other events on the business operations. There are four main financial statements usually used are the balance sheet, the income statement, the cash flow statement, and the statement of retained earnings. They are not isolated from each other but are closely related to each other as shown in the following diagrams. First of all, I will talk about the income statement. The profit or loss reported in the income statement is incorporated in the account reported in the balance sheets at the end of the period. On the other hand, the net income, as we know, is the financial outcome of the income statement, which will flow to the retained earnings in the balance sheet. The profit and loss recognized in the income statement is included in the cash flow statement under the segment of cash flow from operation activities. The net profit from loss during the year is also represented in the statement of change in equity. Secondly is the balance sheet. The name of this statement describes its purpose. The balance is always balanced. This financial statement acts as a record of firm assets and owns the claims against those assets. For example, the change in net assets as a result of the net profit or loss reported in the income statement. Other net gain or losses recognized outside the income statements, such as issues of share capital, payment to dividends, are all reported in the statement of change in equities. The cash from the cash flow statement will be recorded in the cash account of the balance sheet. Now I will come to the cash flow statement. The cash flow statement connects the three financial statements together. The statement begins with the net income from the income statement, and the ending cash balance in the cash flow statement is recorded as cash account in the balance sheet. The cash flow statement therefore reflects the change in cash flows arising from the operating, investing, and financing activities. Lastly is the statement of change in equity or the statement of retained earnings. It is directly related to the balance sheet and income statement. It shows the movement in equity reposition as reported in the balance sheet and account equity at the beginning and the end of the periods. The statement therefore includes the change in the equity reserve arising from the share capital issues, redemption, the payment of dividends, the net profit or loss reported in the income statement, along with any gain or loss recognized directly in the equity.
So, I just listened to my friend talking about the financial statement relationship by showing the change in accounts in those statements arising from day-to-day transactions and events of the firm. I know this is quite a lot of information, though change in here, in there, in different accounts from different financial statements. But trust me, you might be confused now, but don't worry, you will figure it out when you see it by looking in details in any accounting books or asking your friend or your colleague when you are in work. But the most important thing here I want to emphasize is after this video, we hope that we will give you a big picture about the financial statement relationship. By this I mean that why it is so important to understand relationships among them and how to apply it to use this relationship understanding to apply it in the real business, in real life. For example, if you are a director of a firm, I think it's really helpful in helping you that manage your firm well. Firstly, I want to talk about the comparative balance sheet. Comparative balance sheets show a company's worth over several years. The total worth is calculated by adding up all assets and liability to get one large net worth. Liabilities must be subtracted from the own asset. for a total value. The operational funds reviewed on the cash flow statements and income statements may immediately affect the total worth seen leftover profit from the operations is categorized as cash asset. And next, the cash flow statement versus the income statement. Cash flow statements track how the incoming funds are distributed and spent within a company. The income statement shows how much the company is pulling in after resource waste are subtracted. The relationship between these two documents is really simple. If the company is spending more than it is earning, business owners must examine the income statement to see whether earnings are optimal or affected by massive wastage. Thus, from that we will control to manipulate and control to fix that. Poor production may result in larger waste than income, which affects the funding available for operation. In month-to-month expenses, business owner placing cash flow and income statement beside one another over a period of a fiscal year can determine how the budget within their companies have changed. For example, the cash flow statement over a single year reveals how much a company is spending on necessary expenses, such as new computers for the office, other properties, or car rental for managers, etc. The relationship between cash flow statements is important as it shows how well a company manages its available funds. And lastly, I want to talk about how the understanding about the financial statement relationship will help us in the future projections. Balance sheets, income statement, and cash flow statements all play a role when projecting a company's financial standing over the next fiscal period. A balance sheet showing a negative net worth gives manager goals to increase the net worth by paying up liability or purchasing asset. And a cash flow statements are used to determine where budget cuts should be made to put funding aside to purchase assets for the net worth goal. The income statement shows how much a company is currently earning each month, which plays a role in the management of expenses and budget. So you can see the relationship between them and the importance of each and importance of the combination of them together. Now time for question. Which financial statement is most important? I know we usually say that we should have all those three main financial statements together. But for example, if you just have to choose one of the financial statement, which one will you choose? And I would say it depends. Depends on what? Depend on who is asking, but generally the cash flow statement is most crucial, especially for the investor. They explain that the cash flow statement defines a firm's financial options, whether it be a leverage buyout, dividend distribution, or restructuring. The cash flow statement tells financiers what their options are. From their perspective, cash is king. And furthermore, you know that cash flow statement consider nearly combination of balance sheet and income statement. Or in other words, if you have cash flow statement, you nearly have balance sheet and income statement. So now your turn. If you could only have two of the three core financial statements, which two would you take? It's really easy, isn't it? And if you want to answer this question, you can leave the comments below this video. And this is the end of our video. Hope you guys enjoyed it, or at least we don't want to make you fall asleep. Goodbye.